Okay, and the clock strikes the top of the hour, 1 o'clock. So let's get started. Welcome to our presentation, Coronavirus and Your Cash, Reassessing Your Finances. The presentation is sponsored by the Providence Community Library and also SOFA, which is the Society for Financial Awareness. It's a national 501c3 public benefit company, which is dedicated to providing adult financial education in communities all across America. You can get more information on SOFA at sofausa.org. Just a little bit about myself. My name is Michael Graff. I am the director of the Providence and Boston chapter of SOFA. I have a lot of years in financial services, according to my resume, 35 years and counting, actually 35 plus years in financial services. I'm not going to tell you everything I've done, obviously, but been doing it a long time. I am also the author of a book called 6 Steps to Retirement. And I'll tell you a little bit more later on in the presentation how you can actually get a complimentary copy of that book. Let's see, I'm going to just quickly read a disclosure, which is required according to all the attorneys out there. This presentation is for general information purposes only and is not intended to provide tax, investment, legal, or insurance advice. It is recommended that you seek the advice of a qualified tax, investment, legal, or insurance professional before adopting, implementing, or making any decisions with regard to your finances or any information you may pick up from this presentation. One thing I do want to say very quickly is oftentimes when I do these presentations, they are accompanied by an actual PowerPoint presentation. I don't have the ability to show you the PowerPoint, so I'm going to do my best to kind of, talk you through it, walk you through it. So hopefully I'll do a good job with that. First of all, I just want to talk a little bit about what we might be characterizing and referring to as the new normal. So what is the new normal? What can we expect, from the post-COVID world? First of all, working remotely. How many of us are going to end up not going back to the office, not going back to places of work and working out of our homes and other remote locations? Also, what about social distancing and wearing masks? Is that going to be part of the new normal? How about this elbow bump thing that that people are doing? How many people are doing the elbow bump? I'm not doing that. But no, what's happened to the handshake? Is the handshake actually now a thing of the past? Who knows? I'm actually doing the Vulcan, the Vulcan greeting. I think that's a cool thing to do. Not with everybody, but occasionally when I know I can get away with it. In any case, how about Zoom meetings and Zoom get-togethers? Back in March, my family, my 3 kids are all out on their own. They're local, but they're out on their own. We actually had dinner using a Zoom get-together. That was interesting. How about Uber Eats and Grubhub, replacing restaurants? Could that be part of the new normal? Piped in crowd noise. Have you been watching any of these baseball games? You see the guy up at bat, hits the ball and the crowd goes wild. And then they pan around to show where the ball, was hit. And you realize there's nobody in the crowd. So they're just piping in this crowd. It's eerie. It's freaky. Anyway, how about online shopping? I used to buy a few things online. Now I'm basically buying everything online. What does that mean for the shopping mall or the department store? What's the new normal going to be there? How about 0% savings rates, stock market volatility? How is that going to be influenced? Escalating US and global debt, rising tax rates, in part because of that rising debt. And how about the vaccine? Is the vaccine going to fix everything? Let's hope. Who knows? But another part of this new normal is essentially just uncertainty, not really knowing what's going to happen. And as part of that uncertainty, what about financial uncertainty? Well, that's what we're going to really try to address today. The agenda for the meeting is going to be how the coronavirus compares to other past economic shocks that influenced the market and the economy, factors that have impacted the economy and stock market, some of the factors that we have to pay attention to. What will a potential recovery look like? And how to go about reassessing your finances. And finally, the 3 action steps that you should be taking right now. And also, again, as I mentioned, I'm going to let everybody know how they can get a complimentary copy of my book. So, certainly, we find ourselves in very unprecedented times. Things have been closed down, businesses, places of entertainment, et cetera, just pretty much closed out, and we're having trouble trying to get them back online. Our lives have been put on hold. Unemployment rates have, we haven't seen these rates since the Great Depression, and certainly the stock market went through a period of volatility. Who knows what that's going to do going forward? So certainly unprecedented times. So how does this crisis compare to other crises of the past that have, again, impacted the economy and the stock market? For example, the Great Recession, which we remember from 2008, the dot-com bubble, how about and the September 11th attack? How about the oil embargo? Going way back into the 70s, the Cuban Missile Crisis and the Great Depression. Obviously, past crises that have impacted the markets and the economy. So in the last 50 years, just to be a little bit more specific, kind of looking at it from a historical perspective, 1973, 1974, the oil embargo and Watergate. I was in my teens at that time. I remember it. The stock market lost almost half its value. Then Black Monday, the worst day in stock market history. Then how about, again, the dot-com bubble, as well as the September 11th attack, that 2-3 year period at the beginning of the 2000s that caused the market to decline again, about losing half its value. The Great Recession, which actually saw the markets lose more than half its value. And then again, right up until, very recently with the coronavirus crisis between February and March of this year, we saw a dramatic decline in the market. So again, some of the more pronounced stock market crashes or corrections, if you want to use that word, of the last 50 years. Now, the good news is, if you want to think of it this way, is that if you look back at history and you go way back, to the early 1900s, the stock market has always seemed to recover from these crashes, from these corrections, and has actually had, with peaks and valleys along the way, has had an upward trajectory. It has gone up. So that's the good news. So will that continue to be the case? We don't know. In other words, just because we can look at history and say the stock market has recovered from these problems in the past, does that mean we're out of the woods this time around? Well, what we have to do is look at some of the factors. For example, the unemployment rate, corporate profits, and what's going on with businesses in general, the stock market volatility, and also consumer confidence. So let's look at each one of those quickly. First of all, unemployment. If we look at unemployment up until March of this year, it was going along at, it was getting better and better. We had some problems around the Great Recession, but it improved, and it was improving all the time. Then we saw a dramatic spike in unemployment, not just first-time claims, which have actually gone down in more recent months. But what we see that's a little bit more disturbing is the fact that ongoing claims, people continuing to collect, has actually continued to go up a little bit. That has not leveled off quite as well as the decrease in new claims. And we haven't seen unemployment rates like this since the Great Depression. Obviously very concerning. Now, corporate profits. 80% of CFOs expect that what's going on this year is going to have a dramatic impact on corporate profits, obviously. Something published on April 1st of this year, healthcare organizations and other major companies are becoming increasingly pessimistic that their bottom lines will not recover anytime soon. Actually, a couple of recent headlines. This is from Yahoo Finance. A scary number of retail companies are facing bankruptcy amid the coronavirus pandemic. Business Insider, this is just 2 days ago, U.S. bankruptcies are on track to hit a 10-year high as coronavirus pandemic continues to slam businesses. This is from Bloomberg 2 days ago. Small businesses are dying by the thousands, and no one is tracking the carnage. They're having trouble keeping track of what's happening with small businesses. And then we look at stock market volatility. Now, you can't see the chart, but if you look at, February 19th of this year, uh, looking at the previous year, the S&P 500 was up more than 13%. The Dow is up more than 8% over the previous year. And the NASDAQ was up almost 20%. That was as of February 19th. Then a month later, the markets had obviously crashed to the point where the S&P going back over the previous year was down 25%, the Dow was down 31%, and the Nasdaq was down more than 16%. That was in 1 month. Now things have recovered. The S&P is actually up for the year now. The Dow is more or less break even, and the Nasdaq is actually up, believe it or not, more than 28% according to what I have here. So again, this kind of volatility is something that's a concern because it feeds into market sentiment, what's referred to as fear, the impact of fear on the markets. Now, there's an index referred to as the Vix Index, which is a measurement of how people feel about the market. And again, it's difficult, without looking at the chart, but there are spikes periodically. Beginning of 2018, there was a spike in the VIX index, and there was a corresponding drop in the market. The beginning part of end of 2018, there was again a spike in the VIX index, and there was a large decline in the market. Right now, again, same thing. There's a lot of fear, a lot of anxiety surrounding the markets. The VIX index is up, which has caused, or early in the year caused, a corresponding drop in the market. So a lot of what happens with the market is not necessarily tied to fundamentals. It's tied to how people feel, what their fear factor is. Then there's gross domestic product, which is a measurement of what the economy produces in goods and services. Now, going through, 2016, 17, 18, 19, it was running anywhere from a couple percent up to maybe 4% odd, which is perfectly fine, perfectly acceptable, a nice growth level for the economy. In the first quarter of this year, it was down 5%. And then in the second quarter, it was down more than 30%. Unprecedented second quarter drop in GDP. I think actually it was the largest single drop in any quarter in history. Very concerning. Now, what you should understand about GDP is that consumer spending accounts for 68% of GDP. So we really have to get the consumer back in the saddle in order to really see the economy begin to recover and show growth again. And then there's the Federal Reserve. What's the impact of the Federal Reserve on what's been happening? Well, if we look back to 2008, the Great Recession, the Federal Reserve had to inject liquidity into the markets in order to, let's just say, save the economy, without getting into all the details, save the economy. There was quantitative easing, or these, these aspects of trying to, get the economy moving again. There was quantitative easing 1, quantitative easing 2, and 3 through the end of 2014 into 2015. And then there was the fact that actually the beginning part of 2018, the Fed was actually beginning to reduce the size of its balance sheet, basically pay some of that back until the beginning of this year and into this year. Now we see the Federal Reserve increasing the size of its balance sheet by leaps and bounds, something we haven't seen in history, in order, again, to stimulate the economy, these stimulus packages. And the sky is the limit on this at this point. We can see Congress really doing battle over this right now. And then there's what type of recovery we might have. You've probably heard of the V-shaped recovery, which is very simply the economy dropping and then fairly quickly going right back, like in the shape of a V. Then there's the U-shaped recovery, which is where the economy drops, but then slowly recovers, more like, instead of a V, where it recovers quickly, it recovers a little more slowly, like in the shape of a U. What I'm concerned about is that it might be an L-shaped recovery, which means the economy drops in value and then mimics what an L would look like. In other words, it doesn't come back up, it just stays down. So again, what type of recovery are we going to have? All right. So at this point, we've been talking just kind of. I just wanted to set kind of a foundation or a perspective for you to be thinking about. So now I want to talk more about what you need to do to reassess your finances given what's going on right now. In other words, how do you do this? What's the process given the level of uncertainty, the volatility that we're seeing in the economy and in the markets, and also, frankly, just to mention it, the political and social divisiveness which we are also witnessing during 2020, which is certainly not helping anything. All right, so one of the things that I use just myself personally is you've probably heard of the Serenity Prayer, where God grant me the serenity to accept the things I cannot change, the courage to change the things that I can, and the wisdom to know the difference. Okay, we've all heard that. Well, the pandemic and the resulting impact on the economy is really largely out of our control. But the decisions that we make regarding our investments and our money are absolutely within our control. So let's talk more about that. So let's start with investing. First of all, here's a question. When is the best time to invest? Now, I want you to just think about that for a second. When is the best time to invest? The answer is, and again, don't overthink this. The answer is yesterday. Next question. When is the second best time to invest? Again, don't overthink it. The answer is today. In other words, if you didn't invest yesterday, then invest today. All right. Critical investing concept. Time in the market versus timing the market. Let me say that again. Time in the market versus timing the market. Now, time in the market refers to a strategy of buying and holding investments regardless of market and economic conditions. In other words, you get in the market and you stay there. Timing the market is about trying to time your investment decisions based on when markets are up and when markets are down. Now, the first one, time in the market, is really referring to passive investing. The second one, timing the market, refers more to active investing. Now, I'm not saying which one is necessarily better. There's schools of thought on both sides. But according to a company called Dalbar, they do a lot of economic and financial research. This company has studied investor behavior and analyzed investor returns, and it consistently has shown that the average investor earns below the average returns of the market. Now, the reason for this, and if we look at the 20-year period ending 2015, the S&P index, the S&P 500 index, averaged 9.85%, almost 10%. That's for a 20-year period. That's pretty good, okay? In fact, that's pretty great. The average investor, however, only had a return on average of a little over 5%, 5.19%. So basically only realized about half of what the S&P 500 actually did. Now, the reason for that is because investor behavior is often illogical and based on emotion, leading to poor long-term investing decisions. Now, for example, there are numerous studies showing that when the stock market rises and hits new highs, people tend to jump into the market. Conversely, when the market corrects or crashes, people tend to sell. They tend to get out of the market. Okay, so they're reacting to what's going on in the market. Now, if you look at historically, the poor performance of active versus passive. For example, if you go back into the 80s, the performance comparison between active and passive investing was about equal. But then if you look at if you go into the early 90s, remember the S&L banking crisis of the early 90s? Well, that's a period of time when active investing actually did better. Fund managers actually did better than, say, index funds or passive investing. But then if you look into the later 90s, when the markets were doing great, Remember the dot-coms and all of, that whole, resurgence, or, that whole stock market growth perspective or growth time. That's when passive investing did much better and active did worse. And again, through the lost decade of 2000 to 2010, active actually did better, passive did worse. Again, so it goes up and down. So it's not necessarily that one is better than the other. A lot of it has to do with market and economic conditions at any particular time. What I have found over the years, working in my business, is that investors tend to make less than ideal decisions regarding their money because they lack a clear strategy. A clear and well-conceived investment strategy will work regardless of market conditions. However, there are three conditions that you need. The first one is the why. Why are you investing? The second one is where do you invest? And finally, the third one is when to invest. So let's talk about each one of those. So what's the why? For example, what are you investing to achieve? What are you saving for? Are you saving to buy a home? Maybe an annual vacation or other lifestyle choices or activities? What about saving for college if you have kids? Or obviously saving for retirement. In other words, what's your why? What are you saving for? A clearly defined goals, then understanding the amounts that you need to save, the time frame for saving that money, and then looking at what's happening on an ongoing basis. In other words, doing reviews to assess your progress is obviously part of a well-conceived, clearly defined strategy. Know what you want and have a plan to get it. Then there's the where. Where should you invest? In the stock market, in the bank, put your money in the bank. How about life insurance? There's a lot of different types of cash value life insurance where you can invest. Annuities are an option. Real estate, bonds, there's all kinds of different bonds, commodities, even certain types of collectibles, baseball cards, stamps, coins, things of that nature. Gold, talk about commodities. Where do you put your money? Where do you invest? For example, if you're investing for retirement, you might be looking at putting money in the stock market by way of an IRA or a 401k, something like that. Saving for college, a 529 plan or certain types of life insurance are effective with that. So, where do you invest to achieve a particular goal? Now, I want to introduce a term here, which you're probably familiar with, but let me just, mention it: diversification. In other words, spreading your risk over a variety of holdings and also a variety of asset classes in order to better manage, spread out your risk. Diversification and allocation is a very important part of what you do in terms of where you invest your money. Then there's the when. So we're talking about really how much you're going to be investing and the frequency of adding to your investments. So one thing you want to be sure of is that whatever you're saving is affordable. In other words, you can, with all the other things that you have to spend your money on, that you can afford to be putting money into investments. Ideally, you want to be saving anywhere from 3 to 5% to as much as 15% of your gross pay. Then there's the how much you need to be saving incrementally to achieve your stated objectives. In other words, how much do you need to save incrementally? How much time do you have? For example, if you have a 5-year-old, and you want them to go to college, then, what do you have, like 12, 13 odd years before they typically would go to college? How much you project college cost will be, and how much do you need to save in order to achieve that goal, keeping affordability in mind, of course, and then calculating that against what you anticipate your average rate of return will be. And again, figuring out incrementally how much you can save. Then there's a concept called compound interest. Now, this is a very important part of investing because it's getting interest or gains on top of gains that you've previously received. So that's the difference between compound interest and simple interest. So compounding over time will grow your investments much, much better. And in fact, Albert Einstein, believe it or not, characterized compound interest as the most powerful force in the universe. Obviously, he dealt with a lot of very powerful concepts. For him to characterize compound interest as the most powerful, I think is very telling. Okay. So the other consideration is dollar cost averaging. In other words, being consistent with how much money you're putting in to whatever your investments are. Again, the market's up, you keep investing. The market's down, you keep investing. Stay the course. Dollar cost average in, a key to successful investing. Then there are other investing considerations. For example, risk. What type of a quote risk taker are you? What's your risk tolerance? Are you more conservative in nature, or are you willing to take more risk, be more growth oriented or aggressive, or are you kind of in the middle, maybe moderate or balanced? In other words, and we have ways to help people to determine what their risk tolerance is, what their risk profile is. Then there's taxation. Taxes have to be paid on income, on gains, all of that kind of thing. So it's a question of when to pay the taxes. In some cases, you can choose that, to pay now or possibly pay later. So again, taxation is an important consideration when determining your investment strategy. Liquidity. Oftentimes, when you put money into an investment, it's no longer liquid. So you have to take that into consideration. What are some of the age restrictions? For example, an IRA, once you put the money in, you can't get it out until you're 59 and a half. Some products have surrender charges. So again, be wary of the liquidity of some of the investments that are available to you. Inflation. Uh, Inflation is one of the least talked about but most important aspects of developing an overall financial and investment strategy. There's this concept called real rate of return. So, for example, if inflation is averaging, let's say, 3%, and you invest money and get a 3% return, well, have you gotten a 3% return? Really? If you think about it from an inflation perspective, pretty much you just broke even. And in fact, a valid investment strategy is to invest for the sole purpose of keeping level or keeping up with inflation. So because inflation will erode really erode your purchasing power over periods of time. And say if you're in retirement, people are living much longer in retirement. It's very important to try to keep up with inflation to maintain your purchasing power. Then there are the fees that people pay. There's expense ratios, investment management fees, loads, transaction and custodial fees, all kinds of different fees. Now, paying fees by itself is not a problem, but it's understanding how much you're paying and understanding the value that you're returning in exchange for the fees that you're paying. And then there's legacy. Some people want to invest because they have a stated objective of leaving money behind. They want money to survive them. So they want to make sure that their investing strategy includes money available to, heirs and organizations, charities, etc. So does that factor into your strategy? Okay, so the bottom line is we're living in very, very scary times. Goes without saying. So what type of money manager investor are you going to be? Are you going to be sort of, head in the sand, or are you going to be your own sort of financial superhero? So it really comes down to to terms that I actually talk about in my book. It's being proactive versus being reactive. Now, I'm going to read you a quote here. By definition, proactive people approach things with a purpose and a plan. Reactive people deal with things as they come up. Well, that's actually a quote right from my book. It's on page 7 of 6 Steps to Retirement. And what it really means is being proactive with your money. It means having a purpose, knowing, what's your why? What are you investing for? What are you trying to achieve? And then having a plan, a very specific strategy, a plan that will help you to move closer and ultimately achieve your stated purpose or purposes. All right, so what's next? Well, essentially there are three steps. I talked about this earlier when I introduced the presentation. The first step is balance sheet. The second step is budget, and the third is breakdown of investments. So let me talk about each of those. So there's the balance sheet. First of all, when formulating a balance sheet, this is an activity that requires that you take an inventory of all of your assets and debts. If, for example, retirement savings, different types of investments and bank accounts you have, if you own bonds, annuities, life insurance, cash value life insurance, any type of real estate you own, and also debts like mortgage, credit card, auto and student loan debt, etc. It's assimilating all of that into a balance sheet so that you know what your net worth is. Now, net worth is a very important number to know because essentially it's the sum total of all of your financial decisions and habits. So you establish your net worth and then you track it over time. Now, if your net worth is going up over time, then that's a good indication that you're doing the things you need to do to properly manage your money. If, on the other hand, your net worth is erratic or it's declining, then that's indicative of perhaps not managing your money as well. Although in retirement, a declining net worth is not as much of a problem. But again, the bottom line is no matter where you are in life, it's important to have your balance sheet updated so that you know what your net worth number is and you know what your number is on a regular basis. Know what you have, where it is, and what it's all worth. And I have some tools that I provide to the people that I work with to help them to establish and maintain their balance sheet. Not everybody does, it's not. Some people are more keyed in on that than others. But again, it's part of the process, and at least as their advisor, I know what their net worth is, even if they're not, paying as much attention to it. But I've got some good software and also hard copy forms that can be used to help you with this. Two is the budget. This step is about knowing how much money you're spending, not just the total amount you're spending, say on a monthly basis and maybe annually as well, but it's knowing where you're spending it. Housing costs, anything to do with with shelter, groceries, personal care items, transportation, healthcare costs, and also discretionary spending. The things you want to be doing. How much money are you spending in these different categories? And then are you spending your money in such a way that there's money left over for saving anywhere from maybe 5 to as much as 15%? So again, having a budget. And I again offer both forms, hard copy forms, as well as software tools to help people to establish a budget and to track what they're spending in a fairly easy way. It's not complicated. It can actually be done very simply. And then there is the third part of that, which is breakdown of investments. And this step is about analyzing your investments and assessing performance of your investments against relevant benchmarks. How are your investments performing against, say, the Dow or the S&P 500 or some of the other indexes out there? What fees are you paying? We talked about that a little earlier. And what value are you receiving in return for the fees you're paying? What about the taxation of your holdings, your different investments? How are they being taxed now? How will they be taxed in the future? Knowing what your current asset allocation is, especially, against, stock market risk. If there's a stock market correction, how much could you lose based on how your investments are allocated? And again, I have some software tools that I utilize to help people to assess performance, understand fees, look at how their particular portfolios have performed at different difficult economic times, kind of stress, looking how they would be stressed over over different types of periods of time, and also allocations. And then, how are they broken down from a risk perspective? All right, so up to this point, this presentation, we've really touched on a number of different topics. However, we've really only scratched the surface. There's frankly a lot more below the surface. So what I offer is the opportunity for people to call me if they have specific questions and just want to talk in private one-on-one. A phone number you can reach me at is a 508 area code 238 9000. Pretty easy number to remember. Again, 508-238-9000. If I don't answer, then that's actually a landline that goes into my office. If I don't answer, leave a message. I will call you back. And so basically at this point, hopefully you came into this presentation looking to have, some questions addressed, to learn a few things. Hopefully you've come out of it knowing a little bit more. Maybe you've got a few ideas that you didn't have before. And in order to sort of help you to continue to gain some knowledge, beyond this presentation, I'd like to offer you the opportunity to get a copy of my book, 6 Steps to Retirement. You can do that very simply. And if you want to write this down, go to this website, www.sixstepsbook.com. Now that's the numeral 6, okay? So it's 6stepsbook.com. Again, 6, numeral 6, sixstepsbook.com. So go there, fill out the request form, and I'll be happy to mail you a complimentary copy of my book. Also, if you'd like to be subscribed to my weekly economic update, which gives an email with information on what's going on, say, on Wall Street, with the stock market, also in the economy. I send it out every Monday. Just go to this email address and just tell me you want it, with your email address in there, and I'll sign you up. Just need your name and email address. Go to, it's sofawalpolema@gmail.com, Sofa Walpole MA. So that's SOFAWALPOLEMA. That's again, SOFAWALPOLEMA@gmail. And if you would like to set up a meeting with me, we can do a virtual meeting. I actually can share my screen with you, and we can do a little bit more of an in-depth thing. We can talk on the phone, as I mentioned earlier, or if you'd like to do something a little more comprehensive, go to this website. Again, hope you have something to write with, meetingmike.com. That's pretty easy to remember, www.meetingmike.com. That will take you right to my calendar, and you can schedule a time, and we'll do a screen share, and I'll show you some different things, answer your questions. Okay, just to kind of close things out, the purpose of the presentation is help you gain a better perspective on where we are now, but clearly things are very uncertain in the economy and in the markets. So what I hope you have is a better sense that history does show that the economy is fairly resilient. The markets are fairly resilient and have recovered from past economic crises. Now, this is obviously not a prediction of how things are going to turn out this time around, but, okay, again, things you can't control, know what you can control, but by being proactive, and taking actions, some of the actions I suggest here, you'll put yourself, your family, and your business in a much better financial position so that you can be resilient as well. Your goal really must be to gain peace of mind that you are in full control of your finances no matter what is going on in the economy or the stock markets. So the key is to be proactive. So that concludes the presentation. I want to thank the Providence Community Library for this opportunity. Certainly appreciate my association with SOFA. And again, that concludes. I'm going to see if there's anybody that wants to ask any questions. I'm not sure how this works. I'm sorry. To be honest with you, it's the first time I'm using YouTube, so I'm not sure exactly how this would work. Hold on, bear with me. All right. Okay. Okay, so yeah, here's a question. Okay, let's see. Okay, so here's a question. So you're suggesting that we should keep investing right along through this time? Yes, actually, I am. If you think about it, look at what happened in February. The market was way up. It was actually hit all-time highs. Pretty much all the markets hit all-time highs the middle of February, and then a month later they were at all-time lows. Now, history shows that if you buy low, if you buy during these down periods, and again, markets historically do recover. So if you just kept investing, what they refer to as buying the bounce, if you bought at the end of February, then I'm sorry, at the end of March, then you did extremely well. So yes, to answer your question, if you have a strategy, stick to your strategy. Now, I'm not saying the strategy shouldn't be reassessed periodically. They absolutely should be. But if you have a sound financial strategy, then don't let what's going on in the economy, due to some type of black swan event like what we've experienced with the COVID crisis. Don't let that derail you from following your strategy. So yes, stay on track. Let's see. All right, and I think that's all I have as far as questions. Let me just double check. Okay, hold on. Okay, yes, here's another question regarding the election. Yes, well, let's put it this way. Anytime there is a potential change in political power, and again, I'm not predicting, who's going to win, who's going to lose, but the markets will have some type of reaction. However, historically, it's more of a regular occurrence that there's going to be some type of quote reaction, as opposed to something that's going to be like considered a crash. I remember thinking that when Donald Trump won the election, instead of what was expected that Hillary Clinton was going to win that election, that the markets might react adversely. But as it turned out, not only did the markets not react adversely, but they kept going up. Now, it's not because Donald Trump was elected, in my opinion. It was simply that, people just said, well, whoever is sitting in the White House has some influence, but the markets understand that what happens in the economy is greater than who is sitting in the White House. So while it's important to be aware of what's happening in all aspects of the economy, including or in society, including who's running for certain offices. Again, it's important to have a strategy and to maintain that strategy. Keep doing what you've been doing, especially if it's been working. Um, let's see. And okay, so that was the last question. So I'll hang in here a little bit longer. If anybody has any other questions, I'll hang in here a little bit. And all right. Okay, good. Well, I hope everybody enjoyed the presentation. Again, I typically do share a screen so that you can kind of see what I'm looking at or what I'm talking about while I'm talking about it. But hopefully, you still got some good information from this presentation. So with that, I thank you, and again, thanks to the Providence Community Library. My name is Michael Graff. I guess I'll sign off. Enjoy the rest of the day and enjoy your weekend. Goodbye.